Everybody knows Dr. Goodman. He has been a frequent guest of ours over the years. Actually, I owe my discovery, notice I say my discovery, of Robert Goodman to Ed Lashins, who first introduced me to this wonderful man, knowledgeable, without letting you know he's smart. You know, there's some guys and gals that let you know they're smart, you know. But he has given wonderful talks, as you all know. I'm not going to go too much into his background, but he was a chief investment advisor and economist for Putnam Investments, and a consultant to the real estate industry. Has been an economist at various major banks and brokerages and the Federal Reserve Bank of New York. So as Groucho Marx would say, this guy is no slouch. So anyway, without further ado, it is my distinct pleasure, as always, whenever he can come to talk to us, please welcome Dr. Robert Goodman.
Thank you very much. We have a limited time together, so I'm going to make this as succinct as I can. I want to make it very clear that I know what you know. You know more about your business than I do. But I'll tell you this, we are all plugged in. All of our businesses are plugged in to the economy. And so what I would like to do is limit my discussion to what you can expect, what kind of environment you can expect to operate in going forward. And I will tell you this, and some of you have heard me speak before know that I think I started speaking to this group back in 2009. Things were not good and they were getting worse. You know what that meant for your business. I know what it meant for my business. But gradually we started to come out of that. But for 8 years, most of my discussion was negative. Well, I want to make it very clear the conclusion of my remarks right up front in case you have to leave. Not in 3 decades have people in our businesses faced a more business-friendly environment than we do now. That is an economic statement, not a political statement. And that's the problem with my business. If you're going to be an effective economist, certainly in the investment business, you must keep your political leanings, your social feelings out of your analysis. I am talking about the economics and what you can expect going forward and give you the reasons why you can expect this to be the most probable outcome. There are others, but in the end, we have to settle on what's most probable. Many of you know that in 2008, we had a calamity in this country. We were collapsing, very much like what happened to us in the 1930s. Very few of us were around then, but we all read about it. It was a disaster. The ground was falling out from under us. And luckily, the Federal Reserve Board saw what was going on and acted appropriately by literally pouring out liquidity into a liquidity-starved system. To do that, they bought billions and trillions of government bonds. They flooded us with liquidity, hoping that that liquidity would bleed into the real sector of our economy. People would borrow money and spend it, and that spending cycle would carry us forward. That policy worked to a point. We literally pushed interest rates, not just here but around the world, to zero. And in real terms, adjusting for inflation, they became negative. Money was more than free. But in doing that, something else happened. Yes, the economy started to sputter and then picked up a little steam. But in doing that, we faced what economists call a liquidity trap. We had literally severed the relationship between the financial sector and the real sector of the economy. More and more of that liquidity was not bleeding into real goods and services and production and increased demand, but much more of it was bleeding into the financial sector. That liquidity had to go somewhere, and it did. Just talk to anybody in this business that's a broker or a financial planner. They will tell you the stock market, after literally collapsing, turned around, fueled by this liquidity. And while the real economy kind of sputtered along at rates of growth that people considered 6, 7 years ago, 3 years ago, as anemic and well below our potential, the stock market, the bond markets exploded. As interest rates come down, you know, bond prices go up. And interest rates went down indeed, to where Treasury notes were yielding nothing. And bond prices soared. And interest rates on long bonds came down sharply. And at the same time, people decided that better than getting a yield on a CD of maybe 25 basis points, let's take a chance and buy a company that gives us a dividend of 3%. And so the money poured into the stocks. And the stock market rose and it rose and it rose. It went from 6,500 at the bottom to today we're talking about 25,000, as if it were just normal, fed by that liquidity. But what we also talked about at our meetings was that the Federal Reserve Board was out of bullets. There was nothing more they could do to stimulate the real sector of our economy. And if, for any reason, economic or non-economic, our economy sputtered again and begun to fall, the Federal Reserve Board was powerless with zero interest rates to do anything about it. And what we said then, over and over, year after year, was what was necessary was to do what we did during the Depression when we faced a very similar problem of demand. We needed fiscal stimulus, not monetary stimulus. The analogy that I gave, that I remember so well, was you have the best rocket ever made with 2 fuel cells on the side, and you send it into orbit with the objective of getting it to go into orbit, going around and around. And to do it, you used all of your monetary fuel tank. And you know what happens once you're in orbit and you're going round and around. You start to slow down. Gravity starts to slow you down. And our economy was slowing down. And what I said then was what we needed to do was use the fuel in the fiscal tank. What we needed were tax cuts, spending increases on infrastructure to boost us the way we were boosted in the 30s. And what people don't remember or don't know is that in 1932, when we adopted those policies of fiscal stimulus, of tax cuts, government spending on the WPA and the TVA, all those projects, what we did was we started a 4-year period where the economy started to grow at rates that we haven't seen since. In a 4-year period, think of it, our economy grew on average in real terms 8.5% a year, from 32, 33, 34. The market ultimately responds to what's really going on. And in 4 years, from 1932, the Dow Jones went from 44 to 200. That dwarfs what we've seen today. But something happened in 1936, and we should take a lesson from it. In 1936, to stimulate the economy that way by giving tax cuts and spending increases, we borrowed a lot of money then. Our debt was growing, our deficit was growing, and in 1936, before the economy had liftoff speed, we focused on the debt and the deficit. We raised taxes, cut spending, and the economy collapsed again. And we didn't get out of that depression until we felt the demand pull of World War II. Well, let me tell you what we've done now. This is apolitical. The government did it. The Democrats did it. The Republicans did it with all the noise, because just like in 1932, they didn't have a choice. The choice is watching this economy once again sputter, collapse into a hole out of which we could not get. And so what did we see them do? They turned from monetary stimulus, which was impotent, to fiscal stimulus, and we had a big debate. And what they ultimately did is they cut taxes, a huge, deep cut in taxes. For corporations, for individuals, we could argue all day long, certainly economists do, on could it have been done better? Shouldn't we have given more of that cut to individuals who we know will take that money and spend it immediately, rather than give it to corporations who probably didn't need it in the first place, who will probably just increase their dividends or buy back their stock or buy a competitor company? We can argue about that all day long, but you're going to miss the important point. We put, one way or another, over the next 10 years, $1.5 trillion into the system, which will get spent one way or the other. Yes, we cut corporate taxes, and they're permanent. And making taxes permanent is a good idea, because when you make decisions, you want to know you can count on the rules not changing. They did something very interesting in that, though, that does expire. That for me is an investment opportunity. It may be a business opportunity for you. You can now fully expense in 1 year equipment. You can increase your productivity now by buying computer software, whatever, and write it all off immediately. I want you to think about what this has the potential to do to companies that feed that demand, because they're thinking about it already. And the markets are beginning to factor that in. It's very exciting. They focus the biggest tax cuts, irrespective of what you may hear, on middle and lower income individuals. Don't let anybody on TV tell you $1,000 in your paycheck is crumbs. Really? That's a leap. Let me tell you that. You make $40,000 a year, that's big. And you know what happens with that money? It gets spent. And you know what we learned in Econ 101? It becomes income to somebody else who respends it and respends it. The multiplier effect is huge. Does it mean you pay for it all? You don't. I will tell you, over the next 10 years, conservatively speaking, we're probably going to add $10 trillion to our national debt. And I want to tell you something now, and you have a lot of fun at cocktail parties. It doesn't matter. It didn't matter in 1981, it didn't matter in 1990 or 2000, and it doesn't matter today. And there's only one reason why it doesn't matter to the United States. Oh, it matters to Brazil. It matters to Venezuela and France and Russia and China, but not to us. And you know why? Because we can print the money we need. I mean, think about this. What's your name, sir? First name? Bill? Think of it. You go out to dinner, you have a wonderful dinner. You order wine, most expensive thing on the menu, and you can pay that bill by taking the napkin and writing bill on the napkin. You hand it to the guy. And they take it because they know they can tear a little bit of that bill off and give it to the waiter. And he accepts it because he knows he can take a little bit of that and buy a suit, take his girlfriend out to dinner. Until they stop accepting little bills, you can do that forever. The world cannot stop accepting the dollar. We got them where we want them. We can enable ourselves to print the money we need. Now people say, well, isn't that going to be inflationary? Not necessarily so. 2 years ago when I spoke to this group, the concern was what? It was deflation. We were worried about prices falling. Those of you in the real estate business, can you imagine what would have happened to your business Had we gone through a generalized deflation like the 1929-33 experience, where prices were falling, the Fed can't stop that. Because if you think a flat screen TV is going to cost $500 in 2 weeks instead of $1,000, you're going to wait. You won't buy it now. And waiting makes it worse. So yes, we have the ability to do something nobody else can do. Did you ever ask yourselves, probably not, economists ask themselves all that, why is a treasury bond of 10-year bond today, after rates have gone up, yielding just 3%? 3%? If you think inflation's going to average 3% for the next 10 years, that is free money to you. Why can the United States borrow at 3% from our enemies, from Russia, China, you name it? Watch what happens the next crisis. Watch the treasury yields. Don't watch the pound, don't watch the franc, euro. Watch treasuries. They will drop. Because where do they put their money? Where does the world put it when they get frightened? They put it here. They put it here because they're more realistic about us than we are. They see, whether they like it or not, a stable government, freely flowing capital in and out of this country, a financial market that can handle trillions of dollars of cash flow. That's what they see. Doesn't matter whether they like us or not, that's where they put the money. It enables us, it gives us a degree of freedom no one else in the world has. If you're going to worry about the fact that, oh my God, Bitcoin is going to supplant the dollar at some point, or some other cryptocurrency, or maybe a basket of other currency, you can worry about that if you'd like, because they worried about that back in 1981 and 2. And you know what that worry did? It kept people back then from making the kinds of investment decisions they really should have been making. That is cocktail party talk. So what did we finally decide to do? We're going to add $10 trillion to our national debt. It's going to go from 20 trillion to 30 trillion. And if you listen to TV, certain the guys on CNBC, they'll tell you, U.S. government's like the family sitting around the kitchen table. You don't balance your checkbook, you're going to borrow some money, and you'll borrow some more, and borrow. Pretty soon, the bank's going to cut you off. Yes, that's true. But we're not a family sitting around the table. We are the world's bank. And so, what will happen this year at some point, people will stop talking about the dollar size of our debt and talk about what is really relevant. Bill, if we were having a drink together and I asked you, how much do you owe? Just tell me what you owe. And you told me, you know, Bob, I owe $1 million. What would that tell me about your financial condition? Nothing. Absolutely nothing. I'd have to know your income, your net worth. If Bill told me, well, I make about $3 million a year and I got $40 million in net worth, I'll lend you more. But if Bill said, you know, Bob, I make about 50 grand a year, I got about $1,000 in the bank, Bill, you're done. What you have to do in talking about debt is relate it to something. Here's the number that S&P and Moody's relates when they judge the creditworthiness of economies, at least one of the things. It's the relationship between the total debt outstanding and the size of the economy. Right now, we owe $20 trillion. A year's GDP is $20 trillion. We owe 100% of a year's GDP. To put that in some kind of perspective, in 1945, after World War II, we owed $100 billion as a country. And a year's GDP was $100 billion. The ratio was 100%. Before the longest industrial expansion in world history, and a stock market that set records year after year after year. If you take a conservative estimate of what we're likely to see on average over the next 10 years in terms of growth and inflation, maybe 5%, 2.5% growth, that's conservative. 2.5% inflation was probably way conservative. When you do the compounding, and I did it, if you're going to go on your computer now, our GDP is going to be about 33 trillion with a debt of 30 trillion. That's about an 85%, something like that rate. In other words, the burden of our debt, if the most conservative numbers being kicked around by anybody is right on average, the burden of the United States debt at some point will start coming down. The absolute numbers won't. We will run deficit after deficit after deficit. But what it does mean is that you are facing an economy that's been unshackled through some regulation, and not all regulation. There are some things I'd rather have seen not done, but those are social concerns. They are not economic. Through deregulation, freeing up the most productive machine this world has ever seen, to allow it to do what it does best, which is produce goods and services. Can we grow faster than 1.9% a year or 2% a year? You bet we can, and I'll tell you what to expect. We're talking about we're constrained by the fact that our labor force is growing slow. There are people that have literally dropped out of our labor force. There are no opportunities for them. They don't count. They're not seen. They're invisible. And so our reported unemployment rate is 4.1%, and everybody is telling us, oh my God, we're at now the lowest level we can get to. If we start to grow a little quicker, and people begin, as I believe they will because they did in the past, begin to see some opportunity, they'll come back in the labor force, and guess what? The labor force begins to grow faster initially than employment, and guess what will happen? The unemployment rate will start to rise. That will be considered by economists a good sign, not a bad sign. You combine a growing labor force with what is likely to be a renewal of productivity through tax policy and companies building up their productive potential. You add the two of those, and all of a sudden, your potential rate of growth increases, which means you no longer have to grow at an inflationary rate of 2%. You can grow now at 3% for a while. I'm not saying we won't have recessions or recoveries. We will. Don't confuse what I'm trying to say to you. The next debate they're going to have, and it's going to be a big one, is going to be on the other side of the stimulus. Spending. It's going to be about spending. Infrastructure, for a better word. Now that makes economic sense. Okay? Because you put money directly into the system to build something that has a return. Now you are financial people. You know if you can borrow money at 3% and invest it in something that's going to return 4 or 5 or 6, you will do that all day long. And so we can build infrastructure that will have a real return to the American people in terms of lower transportation costs and all the rest. But the debate's going to hinge on how we view the deficits we will incur. And now you get into the political. I don't know how that's going to resolve itself. I don't. And that's why in an investment room, nobody makes the assumption it won't happen. Nobody makes an assumption it will. But I will tell you if it does, if you see progress made, irrespective of the increase in the debt, that's a phony issue. You have every reason, if you're plugged into this system, to feel more optimistic about the outcome for what you do. So that's the economics. What we've done is we've started to use the fiscal tank on that rocket. And the more of the fuel we use, and we have plenty of it, the faster it will go, the higher the orbit, and if you want to go to the moon, just get escape velocity. That wasn't the case a year ago. You didn't have reason to think that was a probability. It certainly wasn't 2 years ago. But it is now. And that brings us to the last part of this discussion. which has nothing to do with the economy in the short run, but has everything to do with it in the long run. And that's how the financial markets react to a lot of this. Markets react to expectations, not to reality. It was very interesting for me to see the market get freaked because we might have 2.1% inflation instead of 1.9. The only people that really got upset about that was the people that were predicting 1.9%. Oh my God, I missed by 0.2%. It doesn't matter. The fact of the matter is, this economy will gradually, slowly turn out numbers that will show you an economy finally expanding at a rate that is consistent with renewed productivity, renewed labor force growth, and the markets will respond, because all of that means is it will drop to the bottom line of many, many corporations, and that's what investors care about. In the end, they don't care about the tree huggers. They do not care about socialists. They don't. They're there to make money for their clients legally, period. So I want to tell you and caution you about what you're going to see in this environment, which many in the investment business will call nirvana. During this period, that gap that we talked about over the years between, for a less of a better word, the haves and the have-nots, the productive and the lesser productive, that gap will inevitably get bigger and bigger and bigger, because what our economy does, it doesn't discriminate between us. It doesn't care about your skin color, your sex, nothing. It cares about your productivity and what you put into the system. And you will, in the end, if the system is allowed to operate freely and productively, you will be rewarded according to your production, period. And the example I can tell you is, did it make sense when A-Rod was playing ball that he made $40 million a year and the best neurosurgeon in this country might have made $10 million? I mean, you couldn't compare the social contribution of these people. But economically, it made all the sense in the world. Financially, it said that A-Rod was worth more than a neurosurgeon. You may not like it, okay? That may really get you. 1 and 1 is 2. Can you imagine if you wanted 1 and 1 to be 3, made you feel good, and you operated as 1 and 1 was 3 and nothing seemed to work, and then some guy shows up at a talk one day and he says, you know what, try 1 and 1 equaling 2. What I'm telling you is the way the system works, whether you like it or not, you're forced to make business decisions, investment decisions in a system that is amoral. Left to its own devices, it will not give us social equality. It just won't. If you ask it to do that, if you try and put a round peg in a square hole, we will wind up with so much economic difficulty, it will overshadow anything we've experienced so far. So the good news is, what can you expect out of the markets? Interest rates are going up. They are. It was just a year or two ago, we thought they were going to go below zero. We were told the Fed could literally push them below zero, have a QE 5, 6, 7, buy up all the debt. Now rates are going up. But rising rates don't mean a bad stock market. The question you have to ask yourselves is, why are rates going up? If rates go up reflecting increased borrowing by excited consumers who want that car, who can get the cash, where the liquidity is available, by business people borrowing money to build plant for demand they see out there now 2, 3, 4 years in the future, rates are going to go up because of supply and demand for credit. That's a good reason. Profitability is going to increase. Why? Because rising wages, which everybody wants, will be offset by rising productivity, so unit labor costs don't have to skyrocket. Profit margins expand. And investors react to that when they figure it out. So it makes me very pleased to give you what is, in an otherwise dismal environment, some good economic news. What can upset all of this, and I don't want you to think I'm naive because I've seen it happen, is not an economic event. Policy is set. They just got to figure out how do we sell this to the American public. How the people have told us that deficits are bad under all circumstances, tell their constituents, not so bad when you do it for this purpose. But they figure that out. It will be a non-economic event, if there's going to be one at all, that could derail this and send us into absolute chaos. Each of us can come up with our own non-economic event that could upset expectations, calculations of the best economists and financial people, the best builders, something we have no control over, something that investors call the black swan. When it happens, or if it happens, I should say, it'll look so obvious. How didn't we know this was going to happen? We even talked about it. No one makes investment decisions based on black swan events. I once gave a talk years and years and years ago, and a woman in Florida said to me, Dr. Goodman, what if we have a nuclear war? What would that do to your forecast? All I could say to her was, ma'am, that would not be good. But nobody sits down and puts that into their calculations. Nobody. So what I'm telling you is tonight, knowing your businesses the way you do, don't ask me what I would do if I were a banker or a builder. I don't know. My friends are bankers and builders. They know. Ask yourselves, what do I do tomorrow if this actually happens? How do I hedge myself against something like this actually occurring? These are the decisions that people made back in 1982 on the expectation that what we were doing then, which was really weird, was going to work. So that's what you got to do, with the wind finally at your back, not in your face. And I'll end it, because I see him walking around the side there, by saying that if I'm lucky enough to get invited back next year, same time, that what I can say to this group is, I told you so. Thank you very much. Thank you.
You know, it's really amazing. Every time I hear this gentleman speak, I find so many things that really affect me personally. My black swan event that I'm still waiting for is I've kind of squirreled away a good amount of the old Italian lira in the hopes that, you know, in the full expectation that Italy will dump the euro and go back to the lira, and I will have made a small profit, you know, but that's just it. But anyway, we have time to take, I guess, as many questions as Dr. Goodman would like.
You said 8 o'clock, that was 8 o'clock.
But since his stamina is a lot better than mine, we'll take a few questions. Hopefully we'll wrap it up by around quarter after the hour. Jane?
Yes, you were speaking about the unique benefits that we gain from being the world's sole reserve currency. Could you speak a bit about challenges to that, and how long can we continue to hold that status?
Okay, the question is, it's a good one, but the status of the dollar, we have a unique position. How long can we hold that position given the challenges that we face? In our relevant investment horizon, I would say the odds are very, very, very slim that it's going to factor into any of our investment decisions. Can it ever be replaced? Yes, if you can get a country that can become a unit of account with its currency, a reservoir of value. Yeah, you can find a country that has freely flowing capital with a stable government that we're willing to accept. That country could very well take over the position of the dollar. The likelihood on probabilities is very, very small. And so there are much more pressing problems that we should be worrying about than that one. Although it'll come up in the topic, Bitcoin, the rest of it, you see what's going on there.
I would say, just like Jane did, she got up and asked the question. I ask anybody else having questions to get up, articulate your question, and then Dr. Goodman will repeat it.
Yeah, I'll repeat them quickly. Yes, sir.
1932 was kind of the economy was focused on the United States. Now we are a global economy. What do you think about the $1.5 trillion? Are they going to stay in the U.S. or kind of go outside?
Okay, the question is, you know, back in the 30s, we were bigger than everybody. We were the world's economy. We called it in economics the rest of the world. They were really kind of small. Now they're much bigger. Question was, the $1.5 trillion we're spending, will it go overseas for imports into the United States? To the extent that makes business sense, yes. Will all of it bleed over there? Probably not. A good portion of, it's a good question, a good portion of it will stay in this country, but for economic reasons. Not because we impose tariffs or subsidies on anything. You do that and you're looking for a world collapse. So the odds are most of the stimulus will reside here, but that will stimulate our economy, which will in turn stimulate other economies through our imports, which get them to grow a little faster, and the whole world picks up. So it's not just a U.S. market, stock market, it's a world market. Last thing I want to say this before I forget. The question comes up, well, okay, what the hell do I do? Everybody here has a different investment objective. I will tell you, I don't know one stock from another. What you need to do in concert with a financial planner is make sure you are properly allocated, that the risk in your portfolio reflects the risk you need to take. Many people, a lot of my friends in their 70s, think like 30-year-olds. They don't have to. I know 30-year-olds think like 70-year-olds. They don't have to. But if you need a 4% return on your portfolio to maintain your lifestyle for the rest of your life, don't take a 6% risk. I don't care what the stock market does. Stand there and watch it go. And what you do have in the market will go with it, but don't over-invest. Don't under-invest for sure. But be very, very careful. The temptation is huge. You know what the big tip-off was? Not that I did anything about it. To what just happened in the market when it dropped 10% in like a week? Do you know in the last month, more individual brokerage accounts were opened than in the last 6 months than in any previous period in 20 years? You know what that was saying? The little fellow's been sitting in CDs watching the market go from 6,500 to 25, couldn't resist anymore and got in right at the beginning of a cyclical contraction. It's like that shoe shine boy that gave that fellow the tip. He knew it was over. Please be properly diversified. Enjoy what's going to happen, but you'll be able to sleep at night. Okay? I'll take one more. I don't want you guys to.
George.
Yeah, first off,
Yeah, George.
I wanted to just congratulate you because I recall I was here last year and you talked about how we were facing a binary event, whether we got this or we didn't get it in terms of tax policy. And congratulations, you're very right. I wanted to ask you in terms of now with the Federal Reserve tightening monetary policy, how much more powerful, or everybody keeps talking about the concern, as you mentioned, about rising interest rates, but will the growth of the economy so far outweigh any mild contraction in interest rates?
All right, if I can summarize it, a great way to end this, because he's saying that with the Federal Reserve Board now is in the process of raising interest rates, will growth far outweigh the concerns of rising rates, or can rising rates ultimately cause a collapse? Let me tell you what's happening today, which is really, really good news. It started back in 1979 with Paul Volcker. When Paul Volcker came in, interest rates on a U.S. Treasury were 15%. A CD was 20%. Money market funds, 20%. Mortgage rates, 17.5%. And some people actually took them out. When Volcker came in, he said, look, the game is over for the Fed. We can no longer lead the bond market around by the nose. Because up until then, if the Fed wanted lower rates, all they did was lower short-term rates, which they control those. And what bond investors would do, seeing the rates on their short-term stuff going down, they ran out on that yield curve and bought the higher yielding bonds, which pushed long-term rates down and bond prices went up. And that's the way it worked. But every cycle, interest rates were higher than the last cycle because of that, because the Fed was building in this huge inflation pressure. Until 1979, and when Paul Volcker came in, he said, we can't fool these guys on Wall Street anymore. These bond investors, they're pretty sharp. What we're going to do from now on is not try and lead the market. We are going to follow the market. And if long rates start coming down because it looks like inflation pressure is easing, we'll lower short-term rates. And if long rates are going up because inflation's picking up or growth is too strong, we'll follow those rates up. That's what the Fed is doing. And what that means is, over the longer term, much less inflation pressure will be built into the system. And the Fed gets back some of the ammunition that it used up over the last 8 or 9 years. They desperately want to get rates back to some level where if they have to lower them again, they can. So the Fed is pursuing a monetary policy that's been pursued through Volcker, Greenspan, Bernanke, Yellen, and now this fellow Powell is probably most likely going to do the same thing. It is very good monetary policy because the Fed is following the dictates of the market. Because if it doesn't, if it tries to shove rates down or push rates up, and the bond markets don't think that's appropriate, rates go in exactly the opposite direction. If the Fed were to really try and raise those short rates inappropriately, bond investors would suspect a recession is going to be coming. And what do? We know rates in a recession go down. So what do? In advance, you buy bonds. And sure enough, rates would go down. So the Fed would be seen raising rates into a declining long rate structure. Wouldn't work. So you got a very healthy monetary policy right now, a fiscal policy going in the right direction, and a market that might have gotten ahead of its skis a little bit, but is grappling with the fact that there are numbers out there on the Dow Jones at reasonable multiples that make your eyes water. Always be aware of that black swan. Always. And so that's the way I would like to leave it. I want to thank you all so very much. Really, it's a pleasure to talk with you. You've become friends of mine. Thank you very much. Thank you.